pleasure to be the moderator for this session, panel discussion. And we've invited a number of prominent speakers globally. Basically, we're going to discuss about global economy 2023 and, how do we reassess the potential risk of the economic downturn ahead, So we'll have comprehensive discussions. First, I think to actually understand the current state of the global economy, and then look at the key risks as well as challenges and as well as opportunities economy going forward. So as we are aware of today, we are kind of being plagued with the stubbornly high inflations resulting from the supply side disruption due to the impact of the pandemic, and then also the prolonged Russia-Ukraine war. The global central banks have responded with significant rise in interest rate, and then this has kind of triggered global economic slowdown and also recession worries and concerns. Financial markets, as we are aware of, have also been hit with declining stock market and capital market outflows. But early this year, we've actually started to see the inflation rate has been cooling down a bit, along with the growing expectation that interest rate probably might be peaking earlier than what originally projected. So, do we think the economic crisis will soon be moderating? Are we close to the turning point, and do we see actually the end of the tunnel? So we'd like to get some insight and answers from our speakers today. So let us welcome 4 distinguished panelists to help us answer these questions. First one, we'd like to welcome Professor Jeffrey Frankel. He's the James W. Harper Professor of Capital Formation and Growth from Harvard Kennedy School. Professor Frankel is joining us online from Boston. Welcome, Professor Frankel. Second panelist is Professor Maurice Obstfeld. He's a professor of economics at University of California in Berkeley. He was the chief economist at IMF in the year of 2015-2018. So welcome also Professor Obstfeld. Now we'd like to come to actually welcome on stage to our distinguished panelists. First is Dong Chan Lee. He's the director from BlackRock in Singapore. Welcome, Mr. Lee. And also Hazem Ben-Gacem. He's the co-CEO of Investcorp. Both these gentlemen are based in Singapore, so we're very fortunate to have them. So we'll have 2 rounds of discussion. So because of the late night in the East Coast and West Coast, we probably will focus on some of the questions to Professor Frankel and Obstfeld, and then probably we'll go to Mr. Dong Chan Lee and Hazem Ben-Gacem in the latter part of the discussion. Professor Frankel, we'd like to start with you first. In your recent article, you mentioned that actually global recession is not inevitable and it can be avoided. Can you elaborate a bit on why you think that the global recession may not happen at all? And if you compare the current state of the economy with the past period of crisis, such as global financial crisis in 2008, what are the key differences? And after that, probably you can also give us your insights on whether the global policy responses taken by the central banks are sufficient or not. And if you were to give advice to them, what would be other options for the regulators to actually help minimize the potential impact of the slowdown to the economy? We'd like to get some insight from you, Professor Frankel. The floor is yours.
Well, thank you, and thanks to the Mandiri Investment Forum for inviting me. We're getting really accustomed to bleak forecasts, whether it's the climate or politics or economics. Many economists spent all of 2022 forecasting recession, and I understand a majority of American economists still forecast a recession for 2023. And we hear much talk about a world recession. Apparently a majority of Americans think we're already in recession. Well, I'm going to take a more optimistic viewpoint. I'm going to be arguing that the glass is half full rather than half empty. And I recognize that there's still a lot of hardship in the world in the aftermath of the pandemic. I recognize that the risks of recession are higher than they are in an average year. But I'm taking an optimistic viewpoint because most forecasts, I think, have gone way too much on the pessimistic side. Let's start with the U.S. You see the graph, the bar chart showing the growth rate. Last week, the U.S. government announced that the growth rate in the fourth quarter was 2.9%, and for the 2022 was 2.1%. You see 2.1 there. Can I go down on the, can we go to the next? So I highlight what I want to highlight. There's a 2.1%. Now, most of the reporting is what a tremendous slowdown this is from 5.7%, which was last year, 2022. And it is a big drop, but 5.7% was an extraordinarily strong year in the U.S. and in the world because of the recovery from the pandemic recession. We're still well above zero, which is you could take as a measure of recession. And I think the best comparison is the average. You see that orange dotted line there. The average growth rate that the U.S. has run in the course of since the turn of the century. So we're actually a little above average. Next slide, please. Something similar is true about advanced economies in general. I put up the forecasts of the International Monetary Fund, the OECD, and the World Bank. And just yesterday, the IMF updated its forecast. Growth in the advanced economies is expected to fall to 2.7%. It was 2.7% last year, and expected to fall to 1.2%. Next, please. But this is still a growth rate that's well above zero. And I think the difference among these forecasts isn't so much that the IMF is a more optimistic agency in general, but just the 3 weeks since the World Bank's forecasts had brought us some good news. I think that explains part of why they're forecasting the better growth rate of 1.2%. It doesn't sound very good, 1.2%, but remember what we wanted, what the central banks wanted was a soft landing, a rate of growth that was a little below potential output, unemployment maybe a little bit above natural rate of unemployment, enough to bring inflation down without actually causing an outright recession. And that's what we have in the forecast here. It's a forecast for a soft landing, as rare as that is. Next slide, please. Well, here's a growth rate of global GDP. And I've got the dotted orange line at zero. This is the years from 1960 to 2021. You can see that we don't want to use zero as the criterion, the threshold for growth to define a recession worldwide. Emerging market and developing economies grow faster on average, and in this whole 40-year, 50-year, 70-year period, 60-year period, only twice has the world growth rate gone below zero. So next, please. I've drawn a line at 2%. Professor Obstfeld can tell us with his experience at the IMF what the IMF defines as a recession, but I've often heard 2% used as a better threshold than zero. The IMF forecast yesterday for global growth was in 2023 is 2.9%, which is above that threshold for world recession, and it's actually little above the average, or at the average since the turn of the century for the world as a whole. So I say that adds up to saying that the probability of a recession, either U.S. recession, advanced economy recession, or global recession, is less than 50% in 2023. And that may sound surprising, but that seems to be what the numbers say. That's the end of my slides. Do I have a few more minutes to speak? The reasons for pessimism in 2022 are not hard to understand. In the U.S., we had interest rates rising to fight inflation. In Europe, we had the problem of spillover from the Russian invasion of Ukraine and the high energy prices. In China, we had the zero COVID lockdowns. In emerging market and developing economies, we had debt overhangs from the desirable fiscal expansion to fight the fiscal response to fight the coronavirus. But with interest rates rising and the dollar strong, that seemed to be creating worsening of the debt problems, sustainability problems for developing countries and actually for everybody. If the interest rate minus the growth rate of the economy goes from negative to positive, that makes a lot of debts unsustainable. The moderator asked, how does the current episode compare with 2008 global financial crisis? I think they have one thing in common, which is the bursting of a bubble. In 2008, it was the bursting of the housing bubble, especially in the U.S. and also Britain and some other countries. And we've had in 2022 bursting of all kinds of bubbles. I mean, a big decline in the stock market and bond market, but really identifies it as a bubble, in my view, is the cryptocurrencies and the SPACs and the meme stocks, which seem to be on a bubble path, and most of which have gone down pretty sharply. So that could have effects on, and that's what that has in common with 2008 global financial crisis. But I actually think the current situation has more in common with past recessions, U.S. and worldwide, in that the cause of the recession of 1973, 74, and 1980 to 82 was inflation getting out of control and the central banks raising interest rates and causing a recession. If we have a recession now, it'll be one of those, I think, more than because of the financial markets. But maybe we won't have a recession. It'll differ from all those episodes. Okay. I think the shocks have been receding. All the reasons that I mentioned, grounds for pessimism last year, have reversed. I think that the Fed is close to finish raising interest rates. Tomorrow they'll probably raise interest rates another 0.25%, but I don't think they're going to go above 5%. They'll plateau at 5%. Nor do I think that they're going to come down, as the financial markets seem to think that they'll come down before the end of the year, which is tied up in the forecast of recession. I think they'll plateau at 5% and stay there for a while. Meanwhile, Europe has responded to the energy problems better than we thought. China is coming out of the shutdowns, and I think that explains the increase, the incipient movement towards more optimism, why the IMF's forecasts are slightly better than before, and why I'm optimistic.
Okay, thank you, Professor Frankel, for your insights. I'd like now to move to Professor Maurice Obstfeld. Professor Obstfeld, recently the IMF stated that a third of the world economy may fall into recession this year. We'd like to get your insight. Which part of the world will go into recession? And, which one are more vulnerable than others? And with the recent China stating that they're going to reopen the economy or the country, can it somehow cushion the global growth from falling too deep into recession this year?
Well, I think the very dire prediction of the managing director somewhat conflicts with what the IMF brought out today in terms of arguing that we might be at a positive turning point and raising the projections for next year. Certainly a major factor behind that has been China's reopening. That has improved the forecast of everyone. Another major factor, since this slide is up, has been the behavior of the dollar. As you can see in the chart, which starts in the beginning of 2019, the dollar had a very sharp appreciation in the initial stages of the pandemic as markets tightened and the US appeared as a safe haven. The dollar then depreciated as the US rolled out unprecedented monetary stimulus on the part of the Fed. And since the middle of since July or so in 2021, the dollar embarked on a very sharp appreciation cycle, driven by the perception in markets that recovery was faster in the US, that inflation might be higher, and that the Fed would have to tighten. And in fact, by last fall, September, the dollar was higher than it had been at the height of the panic. Now, the empirical evidence indicates that a very, very strong dollar is negative for global financial conditions, and particularly for emerging markets, which are very vulnerable to dollar appreciation. A dollar appreciation hurts balance sheets, it tightens global financial conditions, it leads to a contraction in trade. And so I think this is part of why we were so pessimistic back in the fall of 2022. But as you can see, the dollar has come down substantially since then. And part of this has been a view in the markets that the Fed is done or is close to done with easing. This has certainly lifted the global economy. It's lifted projections for the US economy. And I'd be derelict in my duty as an economist if I completely agreed with Professor Frankel that recession is extremely unlikely at this point. I think there are serious downside risks. I think the markets, particularly in the US and Europe, may be underestimating the resolve of their central banks to raise rates more and keep them higher until they're convinced that core inflation is closer to their 2% targets. I think the fact that financial conditions are looser may actually prevent inflation from falling as fast as these central banks would have liked. Now, to come back to your question about who is most vulnerable, of course, countries are very heterogeneous. There are certain vulnerabilities that emerged as a result of the pandemic. Everyone went more deeply into debt, and with interest rates higher, these debt burdens are higher. Countries like Indonesia, which have been successful, as we just heard, in maintaining stronger current accounts, preventing deterioration in the public finances, are in good shape to withstand what may be coming. But there are many other countries, particularly lower income frontier economies, that are already in debt distress. I think these are the economies that Managing Director Georgieva was referring to. And if we look around, there are not such big problems in East Asia, which is doing well, which is benefiting from easing financial conditions in the world and from China's reopening. But you look to countries like Pakistan, Sri Lanka, Egypt, Turkey, there are certainly perils on the horizon. A number of countries are already in debt restructuring. So as we go into 2023, there is a chance that those countries could come under pressure. Of course, this is not even accounting for the downside risks, the risk of an intensification of the Russia-Ukraine war, as Sir Ivan mentioned in the earlier panel, a change in market sentiment as a result of a perception that major central banks will be more hawkish, or financial accidents. There are possible legacies of the pandemic period that have not come to light yet and might cause financial difficulties of the sort we saw in the United Kingdom last fall in the gilts market. So yes, things look better. The baseline projection has to be better, but I'm not sure that the U.S. certainly will escape recession, even if the world economy stays above the 2% low water mark, largely due to China's reopening and growth.
Okay, thank you so much, Professor Obstfeld. I'd like to go back to the topic of inflation rate for Professor Jeffrey Frankel. You know, as mentioned earlier, inflation rate has started to cool down in some countries early in the year. That indicate, you know, a potential turning point, especially in the monetary policy. With this trend in mind, what do you think the trajectory of the global monetary policy should be going forward? Do you see any specific vulnerabilities, especially in the emerging markets, that the policy or owners or regulators need to address?
So these are all good questions. I mentioned before that I see U.S. interest rates plateauing at about 5%. And I think my prediction is that, and I would say similar things about the ECB and other major central banks, although they're sort of, ECB is following us with a bit of a lag. But I think my best guess is that because inflation has begun to come down, they won't go much above 5%, but neither will they cut interest rates within this year. I think financial markets are being overly optimistic when they seem to project a reduction in interest rates later in the year. I think the major central banks will want to wait and see what the effects are, and this goes for actually central banks around the world. This tightening cycle the Fed wasn't the first to tighten. Some of the emerging markets raised interest rates before the Fed. So central banks generally, I think, will want to wait and see what the effect is of what they've done, the effect on inflation if it continues to come down the way it has recently, and the effect on growth before they make a different move. I'm also not necessarily convinced by the secular stagnation viewpoint that the equilibrium real interest rate is, in the long term, is going to be substantially less than zero or even equal to zero, but the second stagnationist viewpoint is substantially less than zero, and you add that to an inflation target of 2%. Their worry is that the nominal interest rate will go below. The equilibrium would have to go below zero, which it can't do, of course. I might be right, but I don't see central banks rushing back towards a zero lower bound as opposed to where they were. The U.S. federal funds rate before the global financial crisis in normal times was around 5%, which allowed room to cut interest rates by 500 basis points or 400 basis points in the event of a recession. And I don't see why that shouldn't be a desirable place as much or more so than going back down to low levels.
Okay, thank you. So I think one last question for Professor Obstfeld. You know, we talked in the last 20 minutes about risk, you know, and I'd like to actually get your view on the opportunities for global recoveries. Do you see that potential global recovery happening anytime soon? And what do you think should be the drivers to actually accelerate the potential global recovery that may happen earlier versus later? I'd like to get your view on those opportunities.
Well, I think 2023 will still be a difficult year. And provided inflation does come down, particularly in the US and the ECB, I think there is a chance for recovery to set in toward the end of the year, but I don't think that is at all guaranteed. And I think we will really have to watch inflation carefully. You know, what I sort of worry about in the US, if you look at the stance of monetary policy in the US and Europe, some other advanced economies, central banks reacted very late. As Professor Frankel points out, many emerging market central banks started raising rates even in the middle of 2021, at which point, you know, the writing was perhaps on the wall. Certainly for the Fed, September of 2021, it was obvious that rates would have to be raised. And then what you saw was a sort of panic mode for the Fed and for the ECB with very harsh rhetoric and very big hikes. Luckily, some of the temporary components of inflation have reversed in the face of those hikes. Markets are calmer, and inflation rates generally are lower. But there is a stickier component of inflation that may remain more persistently at a level of as high as 4% for a while. And then the question is, how will the ECB and the Fed react to those? And to what extent will they need to feel the need to really cause a more significant slowdown in the labor market to bring about the 2% inflation target that they want? So I think that is a risk. You know, in terms of opportunities, I think I just want to echo something that Sir Ivan said in the earlier panel about the recent G20 process over which Indonesia presided. This was sort of a remarkable exercise in avoiding total disaster, and the fact that the final Leaders Summit actually was able to agree on a joint communique was remarkable. The Indonesian presidency started out before the outbreak of the Russian invasion with a commitment to moving ahead on the public health agenda that came out of COVID, the joint finance ministers and health ministers task force. And now that we may be coming economically as well as in terms of public health out of COVID, I think these efforts really need to be ramped up and pursued by the entire G20. because we talk a lot about economic threats, geopolitical threats, but the public health threats remain remarkably salient, I think, particularly as climate change proceeds. And COVID was not the first problem to arise in this millennium. As you well know, in the Asian region, and there are going to be others. So there's an opportunity to make the world economy more resilient in many ways, but one way is by seriously funding public goods in the health area, and this includes surveillance, vaccine development, supply chains, a range of reforms.
Okay. Thank you, Professor Frankel and Obstfeld, for joining us. But before we conclude the session with you guys, can I ask a question based on what we heard from you, or what you shared with us, and what you know of emerging market, especially Indonesia, and the fact that this session is being watched and listened to by around more than 20,000 audience globally, and some of them are keen to actually make decision to invest in emerging market or in Indonesia especially. Can you give us your thought whether we should be optimistic, cautious, or pessimistic in making investments to emerging market in Indonesia this year? Will they make money over the long run? We'd like to get just short answer to that question, please.
I'm no expert in Indonesia, but things look pretty good. It was sort of a bright spot in the world economy, along with India and maybe now China. I will say that commodity prices have high commodity prices, which we saw last year, have both winners and losers, and I think it's important that that the winners, who the manufacturers of the producers of commodities, the governments of those countries, use some of the wealth to some of the revenue to protect the incomes of the losers, the consumers of fuel and grains. But I'm optimistic for Indonesia, even more so than the rest of the world.
Okay, thank you. What do you think, Professor Obstfeld? Are you of the same view?
Well, I have to say I'm not licensed to give investment advice, so I generally agree with what my good friend Professor Frankel has said. I think Asia looks very strong in general, and remarkably so, given some of the geopolitical risks in the region, which we unfortunately cannot discount. I think the kind of measures and the very strong management of the Indonesian economy, both at the finance ministry and the central bank, have positioned it very well in the region. And I'm very impressed by the attention being given to the business climate and to issues like inequality. As Professor Frankel said, worries about inequality are not a luxury. They're essential to building a resilient economy and a resilient political system. And so the measures being taken here are to be applauded. The ability of the political process to actually move forward, which I got Sri Mulyani didn't want to mention the United States, but I will, are very important. And I think one of the big threats to the U.S. recovery that we haven't mentioned is political polarization and the likely spillovers both to the trust in U.S. institutions and in the shorter run to financial markets.
Okay, thank you so much for your insight, Professor Frankel and Obstfeld. Thank you for being with us. I know it's quite late in the evening. Thank you. Yeah.
Thank you. It's a pleasure.
Round of applause.
Yes. Thanks for inviting us.
Okay, now we'd like to turn over to our panelists who are with us in Fairmont Hotel today. We've heard from two distinguished professors of economics, and you guys are basically business practitioners who may have the same or slightly different point of views on what we've heard just now. I'd like to start with Mr. Dongchan Lee on the financial market. In the last year, I think there's a lot of hit to the financial market. Investors fearing recession turn to cash. Now, in the outlook for the rest of the year, what do you think about the global liquidity, especially with this potential looming of slowdown or recession? And what do you think the prospect of capital flows back to emerging market, especially with Indonesia? And with China reopening, do you think this will be a threat or opportunity to EM's financial market?
Right. It's an honor to be back here again since 2019. So let me try to share my thought here. So, if according to G4 central bank balance sheet announcement so far, we expect that G4 central bank balance sheets to be shrinking by around 1.5 to 3 trillion from last year, which means that, from the peak of $27 trillion, it may go down to $25 trillion this year, which means that if you compare with the level that we've seen in pre-COVID, which is about 15 trillion, which is still substantially high global liquidity that we have. And the question is whether these central banks can actually reduce the balance sheet as planned, because we've seen a couple of the not QE before. The first not QE that we had was back in 2019 when Fed had to inject liquidity into the system when there was a financial market stability issue with the US repo market while they've been doing the QE for the entire year. And then recently, there was another not QE from Bank of England, and then they had to actually inject they had to do the emergency bond buying program when there was an issue with the gilt market, mainly because of liability-driven investment funds, which tells you that there's a risk on the projections as well. And also, if you think about the recent changes of the China reopening and the much warmer weather, which is giving a blow for less shock from the gas prices in Europe, which means that the probability of the full-blown recession in global should be lower than expected a few months ago. And however, given that globally financial condition has been tightening, which is level is most likely to around 2019 level, which means that we may face another financial market stability issue down the road, which means that this is the risk to global liquidity. In terms of the China reopening, about the capital flows that you asked, I think the three main investment idea for macro investment this year is about three key topics. First one is, in terms of duration-wise, better than expected Europe, which theme can last maybe in the near term. However, more like adjustment of the YCC by BOJ or the reopening of the China theme can actually last in the medium-term perspective, which means that investors should actually continue to focus on the China reopening. The reason that this China reopening theme is interesting is because there are certain investor group which wants to actually play this China reopening theme. However, they are hesitant to invest in China directly because of the many reasons, which means that they would like to find the key beneficiary of the China reopening and try to actually play the China reopening theme through this investment in EM, which is a great opportunity for EM market, because these investors will continue to actually allocate more resources to investment to try to play this theme to benefit from the over China reopening theme. So that's why I think this is actually pretty much a good opportunity for Indonesia as well, because Indonesia is one of the markets that we watch really closely in Asia, which also can benefit if the investor may continue to allocate more risk, allocations to emerging market. Another interesting factor that can support emerging market this year is that potential rotation out of the money market funds to emerging market, because if you look at the past experience in 2019 and 2018, when the monetary policy is actually getting close to the peak of the cycle, then we start to see that people actually move away from the money market funds and then try to move to more actively risky-taking products such as emerging market funds. And also, if you look at the flows of emerging market bond, usually has a tendency to actually track the index return with the lag. If you look at the past 3-month performance of Asian bonds, you can see that Asia FX has actually appreciated more than 9%, and also Asian bond has rallied about more than 55 basis points, which means that eventually investors will continue to actually allocate more because they have seen a good return already. And also, for the last factor that can actually support the emerging market is about that the overall global condition is actually becoming more benign compared to the last few years, because a lot of factors can actually support emerging markets, such as growth. In terms of the growth, we think that China and Asian growth can be above consensus this year. And also in terms of the better than expected euro, which means can contribute to weaker dollar theme, and as U.S. Treasury 10-year moving toward more like only 3% handle, which is also giving some comfort for investment in EM. Lastly, also about commodities. Commodity can benefit from the increasingly positive demand from China as well, which means that overall, we are actually quite positive on the emerging market because of the, China reopening, which is a, opportunity for EM market.
Okay, thank you. So I think there are some degree of optimism and encouragement to invest in emerging markets. Now I'd like to get the view from Hazem. We understand you have extensive experience in making investments across many industry sectors across the globe. Now in the period of uncertainties, we'd like to get your view on what should be the key metrics that investors should actually use or keep in mind in making investment decisions, especially in emerging market like Indonesia.
Thank you. Well, first, I hope you can hear me well. And thank you, Mandiri, for throwing this terrific event and for inviting me. So first, when we think of returns, or we think of investments, we think of one thing, which is returns. But what is more important than returns in an investment? It's the risk you take to make that return. I can make you a 50 times your money on the roulette table, but I only have a 2% chance of doing it. So the 50 times my money is really less relevant. What is more relevant is what is the risk that I am taking to generate that return. As an investor, this is something you learn the hard way. You can very easily get excited about, I'm going to make 30% return, I'm going to double my money and what have you. But that is not relevant. What is relevant is what is the underlying risk you are taking. Now, why do I say this? If you look at emerging markets, and I'll get to Indonesia in a second. If you look at emerging markets, just holistically, a big picture, over the last 50 years, they have not really provided an attractive risk-return formula in comparison to the more developed world. And I think pretty much every single person in this room and also online, you can probably vouch, pretty much everybody have made money in some shape or form in the US. Everybody kind of made money if they invested in Europe or certain sectors and what have you. But you look at Latin America, Africa, certain parts of the world, it's really touch and go. Okay. So that's why, coming back to Indonesia, and why what I just said is relevant, risk are fundamentals and macros that you can control, or a country can control. How do you control it? It's the fiscal discipline, it's the fiscal mindset. And I'm sure many of you, like me, were wowed when you have the president of Indonesia coming here to open this conference. I mean, I tell you, ladies and gentlemen, it's a rarity for the president of a country to come and open a private investment forum. There's no stronger message that the government is sending, that the importance of Mr. and Mrs. Investor, and the importance of seeing this very successful. And that is a big part, I think, of mitigating that risk. I think the slides which the Minister of Finance have put up are very incredible, but also more incredible the way she was thinking of providing an environment which is attractive for the investors. That, Pak Siddik, first and foremost, is, at least for us as a global investor at Investcorp, what we found interesting in Indonesia. It has the bedrock of political will and political means to provide an environment for investors to actually deploy capital, make money, and leave. Have the money go. That's very important. That cycle is very important. I want to see money invested, but also money taken out. And I think that is a big part of, I think, what Indonesia today is truly in a terrific way offering it. Now, hopefully that will take the risk out of the equation. Now, your second question, Pak Siddik, is, well, why is Indonesia attractive? At Investcorp, we are fortunate. Why are we fortunate? We have offices throughout the world. We can literally, I can be here, I can be in LA, I can be in New York, I can be in Japan, Tokyo. Investors today have the choice. And that is something very important. Every single person listening here have the choice to deploy their capital here or other parts of the world. Why Indonesia? Indonesia, at least in my mind, has two terrific assets. First of all, its people. Second of all, the richness of its country. You can't underestimate 280 million population. The sheer power of that population to consume, to drive businesses, to grow, to develop. And I think that we found, and by the way, there are many very populous countries, but some populous countries have a strong sense of reliance on the public sector, reliance on others. In Indonesia, there is this drive. I think, and I can say this without exception, is every Indonesian I have met is an entrepreneur. Okay, even if they are the taxi driver, they're an entrepreneur. They talk about what they're going to do and how they're going to start exporting or doing X, Y, and Z and what have you. And I think that kind of bug, that it started very much in the Anglo-Saxon mindset and is trickling in other parts of the world. It is terrific. We see it a lot in the Middle East. You see it in China, and you very much see it in Indonesia. And that is what makes this market is very, very attractive. Second of all, on the richness of the nation, maybe one observation I'll make is the Minister of Finance, when she talks about the health of the current Indonesian economy, the numbers are correct. However, I fear the numbers may be somehow skewed by commodity prices that have significantly been helpful to Indonesia and this part of the world in general. And that's okay. Similarly, in the Middle East, there's no shame in saying, look, a big part of the economy is doing well because of the oil prices. So that's perfectly fine. But what's more important is, how then do I take that natural resource and then evolve my economy so that long-term it is competitive with or without natural resources? And for us as an investor, in addition to investing in sectors that a populous nation will benefit from, things like healthcare, consumer retail, and what have you, but also I hope that most of everyone in Indonesia will embrace the concept of the downstream value-added investments of the mineral sector. To me, it feels a shame to go to a mine, dig something up, put it on a truck, ship it to Europe or ship it to China. That can't happen. That needs to stop. Value add needs to be captured here. And I think as an investor, there's nothing will get us more excited than seeing that value add captured here, and I hope we'll play a part in that as well.
Okay, thank you for the insight. So I think in this last part of the discussion, I'd like to get the insight from both of you guys, one at a time, about Indonesia. And Hazem, you mentioned that investor has options, that they can invest either in Indonesia or the market, whether it's developed or emerging market. So for us in Indonesia, what do you think, can make Indonesia be better positions in the eyes of the investors going forward? What should we do to make Indonesia more attractive to investors? I'd like probably to start with Dongchen. What are your advice for us?
I mean, honestly, I think Indonesia have done the lot of work already. I mean, if I look at the macro perspective of Indonesia, I mean, current account has actually improved structurally, not just in the near term, structurally perspective. If you look at the next 1 or 2 year horizon, we believe that the current account will actually continue to record a positive number, which means that if you actually think about adding on FDIs and the portfolio flows, BOP will actually continue to be positive. I mean, this is a really big shift of Indonesia compared to the last 5 years or 10 years ago. And then also, as Sirmilian actually said, the tighter or conservative fiscal policy is also helping a lot in terms of attracting or having a positive impact on the macro perspective. So I think Indonesia have already done that. It's just that we can just continue to follow what have done so far.
Thank you. Hazem, anything you would like to add in terms of making the country more attractive?
Yeah, definitely. And it's a long-term investment in education. This is the one thing, at least I feel I see missing in Indonesia compared to many other nations. The future of any nation is a function of the academic institutions, the educational platform that you have in the nation. Indonesia feels to be behind. 5.4 million babies are born in Indonesia. These are 5.4 million high school students, 5.4 million university students. They need to be educated best in class in every single aspect, every single field. This is a long-term investment. I understand there are some regulatory challenges around the educational sector. For Indonesia to be best in class and top performer worldwide, they need to have the very best universities in the world. They need to be here. It's an investment that takes a couple of decades, but it's got to start sooner rather than later.
Okay. Thank you so much, Dongchen Lee, Hazem, Ben-Gacem, for your presence, your insight, and making us feel much better in terms of the future going forward, even though some economists say there may be a recession, etc., but I think we all should be positive, especially for those investors out there, to consider our country for their investment decision. Thank you for coming all the way from Singapore to Jakarta this morning. Thank you.
Thank you. Thank you.
Again, thank you to Bapak Ahmad Siddik and all respectable speakers. Please kindly remain on stage for a photo op. Okay, 3, 2, 1. Okay, one more. 3, 2, and 1. Please give another big round of applause, ladies and gentlemen. Thank you, Bapak Ahmad Siddik and all respectable speakers. So all distinguished guests, after some points of view from the keynote speakers, followed by great panels, it's time to fill our energy pack with a lunch. So we want to inform you that we have electronic vehicles test drive in the South Lobby area near to the registration area. So make sure you come back on time because we have Mr. Periwarjio session